Hello, everyone. My name is Haley Wilson. I'm very happy to welcome you to our Market Insights with Greg Luken, who I have here with me. Before we let him take over the show and get into the good stuff, this is why you're here. I do want to encourage you to share, to follow us. You can easily scan the QR code, or you can follow us on LinkedIn for more great, wonderful insights like this. The recording of this webinar will be sent to you after the event later today. So, without any further ado, I'm going to sit on over to you, Greg.
Thanks so much, Haley. Can you hear me?
Sounds good.
Can you hear me? Great. Appreciate you taking your time to be with us today. We'll get right to the point today. We are going to go through a 3-point sermon. So there'll be a short introduction. I'll cover 3 points of the underpinnings of what we do, the philosophy behind it, how that translates into the tools we use. Number 2, and number 3, we'll get down to specific investments, and we'll do that and try to keep this tight and compact and fun. So you may see me looking down from time to time. That's because I have a couple of notes to help me stay on track and make sure we get the salient points and don't spend time getting as lost as last year's Easter egg. So if you've ever heard me talk about markets before, you've probably heard me say that markets tell a story. Markets always tell a story, and our job is to listen and make sure the portfolios are aligned with the story that the market's telling. Markets change, economies change, risk is dynamic, and so we want to make sure the portfolio is reflecting what's going on, that there is a level of situational awareness about keeping up with the times. I believe that technical analysis is really the purest form of analysis. Why do I think that? Well, everyone in the world, all the money in the world, gets to vote every single day. A buy is a vote, a sell is a vote, and abstaining, doing nothing, is a vote. All the money in the world votes every day. So what we're really doing is taking this data, turning it into information, taking the information, converting that into knowledge and that into insight, something that we can act on, something that's actionable. So going from data to information to knowledge to wisdom or insight so that it's actionable, so that we can act on that. The challenge is always to filter out the noise and just hear the signal. So we have a number of tools that help us do that. We've used these tools for a long time. I started coding back in the early 90s, and by 1993 we had the foundation or the chassis of these signals that we use. I want to point out this is not fortune telling. It is not political. We're not team blue or team green. We're really team U. We are not team red or team blue. We're team green. We're team U. We're all about making sure we're making smart decisions about money so you, our clients, can do what you want to do. So let's get into the underpinning, the philosophy behind this. And that is that there's a problem. And the problem is that markets are dynamic. The problem is that things change all the time. Back in the 70s, there was a concept called the Nifty 50. And the idea was these are the 50 stocks that you buy and never sell. In the late 1990s, it came around again, but this time they called it one decision stocks. So these were the stocks like Nortel that you made one decision to, in General Electric, you made one decision to buy and you never had to think about it again. And if you followed General Electric over the last 20 years, that selling that would have been a great idea. If you followed Nortel, you know that the company filed bankruptcy, doesn't exist. So this whole idea that you can set it and forget it is really a misnomer. So we've got this challenge that markets change. We know there is an emotional cycle that goes along with those market swings. We know that markets change, but people don't change much. So because of that, we need a process to help protect us. And diversification is not protection. Diversification is not risk management. Diversification does not protect us from the downside of markets. The reality is all markets, whether you're talking about real estate or commodities or Bitcoin or stocks or bonds, tend to spend about 80% of their time just declining and getting back to even. Only a small fraction is spent actually making new money. So you think of that 80-20 rule, it really applies to the way markets work. They spend the majority of their time declining and recovering, and a fraction of their time making new money. So the key is, how do we deal with that decline? Because that can be really frustrating. And so our response is always to go back to the 3 rules of investing. Number 1 is to have a game plan for up markets. Number 2 is to have a game plan for down markets. And number 3 is to have a clear way to tell the difference between the two. So we've got a game plan for up markets, but that's different than the game plan for down markets. And if we've got a quantitative method, what we mean is a mathematical way to tell the difference between the two, then I'm not relying on my opinion or my gut or what some self-proclaimed expert says or what somebody on TV said. We're really using math to determine uptrends and downtrends. And we've been doing this for more than 2 decades. So that covers the intro, the philosophy behind what we're doing. And then, so how do we do that? Getting into the tools, because everybody votes every day. All the money in the world votes every day to either buy, sell, or do nothing. And all 3 of them are a vote. So we take data on asset classes, and we have what we call a directional strength indicator. We call it a DSI for short internally, a directional strength indicator. And it measures supply and demand, and it does it by measuring the speed and magnitude of an investment's movement relative to time. So speed and magnitude relative to time. So we take this indicator because a lot of things change, but the law of supply and demand doesn't. And you look at it even in non-financial aspects. In the natural world, if you have a lot of a resource, there is a whole ecosystem that grows up or builds around that resource. And if a resource is scarce, then you see a scant biosystem around that resource. And so this seems to be a very much a constant rule. And so if we think about it, we see it every time we go to the gas station or to the grocery market. I went this week to get some eggs, and the kind of eggs we usually get are gone. They're not at the grocery store we usually go. Most of the shelves are empty. Well, what do you think that's done to the price of eggs? They're way up because the supply is way down. So there is this inverse relationship between supply and demand. And all these indicators do is mathematically measure that. So that's one of the things we use, that directional strength indicator. The other thing we use is a 3-level risk indicator. And it may be easier if I just pull something up here so that you have a visual on it. And let's see, I need to go here and share. So I've just got to figure out how to share. And Haley may be able to help me with that.
You see the present button at the bottom?
I do not. There it is. Share screen. Thank you very much.
It was hiding from you.
Window. There it is. Share. So I should be sharing this blank screen now. All right. So this will pull up, and what we will see is we will see the directional strength indicator in the top part of each chart. And we'll just take the S&P 500 to start with. So we see this orange and blue, that is our short-term and long-term directional strength indicator in that top section. So that gives us the direction and the strength. So we see a general direction of weakening, but the strength is still at a really high level. So I would think of this, hey, you've got a player that has been rushing for 150 yards a game. He's been doing great. Well, he's still doing great, but now he's rushing 100 yards a game. And so still very positive, still moving the ball down the field, but not as good. There's some waning strength there. So that gives us some insights in what's going on. And what we're looking at here is the S&P 500, the US stock market. Then if we look at the bottom, there are some lines underneath that stock chart, and that helps us understand whether we're in red light, yellow light, or green light zone. So what we know, if we look at the research on the S&P 500 that we've done going back to 1950, we know that the S&P 500 has been in green or yellow light conditions about 85% of the time. I talked about that 80-20 rule. It's been in or green light conditions about 85% of the time. And that accounts for 99% of the return of the S&P. It's been in red light conditions 15% of the time, but that only counts for 1% of the return. So what we know is that the big falls in the stock market have occurred during red light conditions. And we know that those are smaller time frames, but we also know there's more risk and there's less return. So the way those conditions are measured is relative to that investment vehicle's price levels relative to time, because we know markets change, but people don't change much. So what I've noticed, I can't find any quantitative research on this. I'd love to find it. If anybody knows where I can get it, please let me know. But when people experience a 5% loss on their stock market investments, they don't generally get that concerned. They notice, but they don't lose sleep over it. They lose 8%, they start really noticing that. But there are levels at which panic occurs. And so what we know is when we get to that red light condition on the S&P 500, we've got a 92% probability that within the next 3 weeks, there's going to be a minimum of a 3% loss. 92% that's a really high probability. So we look at that and we look at those probabilities. Where are the levels that it doesn't really have anything to do with the companies in the S&P 500. It has to do with people's behavior and the way human beings behave relative to their investments. So by looking at different asset classes and their volatility characteristics and the way people typically view risk in those, we're able to flesh out some different risk levels so we can be clear about quantitatively, are we in a red zone, a yellow zone, or a green zone? So let's jump into some specific investments. So this is the bond market as represented by the iShares Core US Aggregate Bond ETF, which just tracks the, I always have to remind myself, the Barclays Aggregate Bond Index. I always want to say the Lehman Brothers Aggregate Bond Index, and that's because I was in this business a long time before 2008 when Lehman Brothers still existed. So, but it tracks a high quality intermediate term bond portfolio. And what we see here is that back here, we had the Fed actually cut rates. And so when interest rates go down, we would expect bond prices to go up. But the story the market's telling is the bond market didn't think that the Fed had inflation under control or that there really was adequate strength in the equity markets. So you saw bond prices go down and yields go up after the Fed lowered rates. Exactly the opposite of what you might think would happen if you just went to a website and say, what happens when the Fed cuts rates? Here again in December, the Fed cut rates again, and look what happened. Bonds went down several percent again, 3.5%, 4%. After the Fed cut rates, which in theory should drive up bond prices. So the market is telling a different story than the Federal Reserve is telling. And I think that's important to note. I'll also say that as of 3 weeks ago, bonds went into red light condition. So traditional bonds, if you have what I would call high quality, high rated bonds, we've been saying bad things about those for a long time, but it doesn't look any better now. Let's go on to emerging markets, still in positive territory, but waning supply and demand characteristics. And it's easy to see why with the threat of tariffs, but they've actually held up pretty well. And the day of this recording, they're actually up decently today. So flirting around now for the fourth week with that transition between red light and yellow light. And we would expect that with a more volatile asset class like emerging markets. Developed international markets, so these are like European markets. And what we see here is it's not positive. So we see the directional strength indicator, the vector, the direction is down, dropping below that strength level of 50. 50 or greater is really positive. 50 or below is in the weak category. So it's in yellow light conditions, but really flirting between yellow light and red light, and just does not look positive, and we haven't had international developed markets in portfolios for most of the year. This is real estate, which today is below those conditions, sending it into red light conditions. Strength really weakening. It's easy to see why. We've had the Fed raise rates, and real estate really didn't respond negatively, and so it's been kind of a delayed reaction there. So we're not really excited, very unexcited about securitized real estate. High yield bonds, junk bonds. This is something that counterintuitively we've said we really like for several months, and they continue to be in green light conditions. The Nasdaq still in green light conditions, but again, here we see the strength is weakening, but that's to be expected. It's been 2 phenomenal years back to back. So that tells us this is still a good time to stay committed from a risk standpoint. The question is are there other areas that look more attractive? In the S&P, the same kind of story. So bonds haven't trouble finding a reason to say anything positive there. The market's telling on bonds is very negative. On international emerging markets, it's kind of at a tipping point. US markets are still the best place in the world to be, according to our signals. High yield bonds, there's some comfort there. So that's taking that philosophy of the markets tell a story. How do we discern what is the insight, what is the actionable information from that? It takes it down to the tools that we use, and giving you a little background on how we do that. So I think that wraps us up for today, and we're getting close to time. So Haley, is there anything else we need to cover?
No, the only thing I will just say, I'll put this back up here again. If you guys will go on to LinkedIn and follow us at Luken Wealth Management, then you can be up to date on all great insights and webinars and events like this, because we're going to do more of these, aren't we, Greg, throughout
We
this
are.
year? So I'm excited. Thank you, Greg. That was terrific. And thank you to all of you who joined us at home. Look forward to seeing you in the future. Thank
Great.
you.
Thanks a lot. All the best.